So let's get going, really. Takeaways from the July FOMC. Basically, the market was a bit disappointed, wasn't it? And subsequently, we've had a pretty sizable dollar correction in the wake of that. Basically, the FOMC didn't do a great deal, didn't really sort of signal any sort of positivity. Obviously, yes, we've had the Brexit decision, but there was no real sort of suggestion that from the FOMC that they were going to be imminently hiking rates in September. So the market took that as a bit of a negative, and subsequently the dollar has sold off. And what you will see, interestingly enough, let me just show you if I can find it very quickly, is you'll often see sharp moves that come in the wake of the FOMC. Here we see the 2-year Treasury yield. We can often see big turnarounds, actually, all the way back to last year, really September. Big turnaround, big falling of the 2-year yield. A slight movement to the upside in December, but then a subsequent big sell-off. The big moves, obviously, March FOMC. Big disappointment in the fact that the market thought that they were going to be doing 4 rate hikes. Obviously, they then sort of recalibrated that to 2. And another one in April, big run up in the 2-year yield in front of the April FOMC, then sold off. And again, a big run up into the July FOMC before the sell off. So you do tend to have these knee-jerk sort of reactions to the FOMC. That can last a week or so, but then gradually the market starts to sort of regain a bit of stability again, and the FOMC, and the dollar starts to strengthen again, or that tends to have been the theme in 2016. So as you can see here, you've had the sharp sell-off on the dollar, trade-weighted dollar back to 95.25 pivot level throughout this year. Trading around that point now. Be interesting to see if that pivot level, I mean, yes, it was broken yesterday, but be interesting to see if sort of the basis of it holds, and it starts to find a bit of support. A couple of signs, there are a bit of support for the dollar today, but nothing too sustainable as yet, but certainly interesting to watch nonetheless. So basically, the FOMC for July was very middle of the road, didn't do a great deal, and it sort of still goes on about data dependency. And the fact is that the data since then has been negative. You've had Q2 advanced GDP was negative, and also since then, since Friday, we've also had the ISM manufacturing data came in pretty disappointingly as well. Not a great deal there. The core PCE also didn't pick up. But I suppose the caveat would be what would happen, what would bring about a change in the market sentiment. We got payrolls on Friday, and payrolls certainly have the ability to change situations. Certainly, we had a strong payrolls report last time out. That changed the market expectations on the Fed. Last time out with a much stronger than expected payrolls report, which also included average hourly earnings pulling higher to 2.7%. So if you had another strong payrolls report, say for example above 200,000 on the headline, you also saw average hourly earnings picking up from 2.7. They're expected to stay at 2.7 this month, but if it started to pick up again, it'd be interesting to see what the market would do, because perhaps they would start to sort of recalibrate once again. Because if you look here, I've got this static chart from yesterday. I took this meeting date of Wednesday, the 14th of December. So the December FOMC is currently priced around 43% probability on the Fed funds futures. So it'd be interesting to see if that basically effectively that means that the market is not pricing in a rate hike this year. Perhaps that's gone a little bit too far. What would happen if we got a couple of months worth of strong payrolls data? The market would then have to reprice that again, and we would see a dollar strengthening. So the market has obviously had a selling pressure through the dollar since that FOMC, but perhaps it's gone a little bit far again, or at some stage it will start to look a bit too far the other way, and you will inevitably get a strong bit of US data that I think turns the corner on this dollar once more. and perhaps it could be payrolls on a Friday. Other issues being Brexit, obviously, and the US presidential election. Brexit, we still don't know really the outcome or the real sort of fallout from the Brexit decision on major economies around the world. Obviously, we're starting to see the UK data deteriorate already, and I'll talk about that in a bit when I look at the Bank of England. But for now, we're not really seeing a huge impact across global economic indicators. Could be different if the contagion from a UK slowdown spreads. But for now, we're not really seeing too much. Also, the US presidential election is so difficult to actually know exactly what's the outlook for the US will be from that election. I haven't gone into it yet in terms of preparing for the event, and I'm going to do some more work on that in the coming months. But you would imagine that a Donald Trump US presidency would be protectionist, would be anti-trade. He's already talking about pulling out the TPP. And anti-trade, protectionist is, generally speaking, isolationist is not good for global markets, really. So that will be interesting to see. But yeah, the US presidential election towards the end of the year could have an impact.